Let's turn back to equity trade, which is about to start behind me. The big question is, how far can this 2-year-old bull market run? Well, joining me now with more is our market expert, Ryan Detrick. He's a chief market strategist at the advisory firm Carson Group. Ryan, it's great to have you on the show today. And as we see stocks right near record highs, how healthy does this bull market look to you?
Yeah, first off, Kristen, thanks for having me. And this is a great news show. I'm honored to be here. Let's put some context around it. Like you said, we just had the 2-year, some people call it anniversary. I like to call it birthday. Maybe we could argue on everything. We can argue on that. I'm calling it the 2-year birthday for the bull. And when you look historically, Kristen, I went back to all 11 bull markets since World War II. The average one lasts over 5 years, right? This one's right at 2 years. This one's up about 62, 63% on the S&P. Your average one gains like 180%. Now, median's a lot lower because we had some extremely long bull runs before. So you don't just blindly say, oh, well, just because it's 2, it's going to get to 3, 4, 5. But, you know, the underlying pinnings that have gotten us here, probably last thing, we communicate or talk a little more. What about market breadth, right? Right now, like literally yesterday, we saw new highs, right? But advanced decline lines on the S&P 500, the NYSE, the Dow, small caps and mid caps all hit all-time highs on Friday. Almost, I think it's like 89 point something. Closed up for government work. Almost 90% of all the small caps in the Russell 2 were higher on Friday. These are signs, again, this market is broadening out. It's not just about 7 stocks. There's a lot of participation, and that's the hallmark of a bull market. Why we think this bull market probably has a lot of legs left, I guess we'll say, Kristen.
So I've got to ask you what may seem like the obvious, Ryan, but I'm sure part of this rally is fueled by money finally coming off the sidelines as yield might look more attractive in stocks with the Fed lowering rates. Is that what it seems like to you?
Yeah, I mean, that's part of it, right? I mean, there's a lot of different reasons we're doing what we're doing here, hitting all-time highs. I mean, 45, right? I believe it's 45 all-time, or 46. Yesterday was 46. 46 all-time highs on the year. Who knows? Just wait a day. It'll go higher. That is like the 9th most new highs we've ever seen in any one year. So, yes, you have obviously the more dovish Fed. That clearly is a tailwind. We saw what the hawkish Fed in 22 did with a terrible year for stocks, terrible year for bonds. That's part of it. But I'll tell you, you're in earnings season, right? And you look at earnings, forward estimates on the S&P 500 are record earnings right now, up substantially more than we were just a couple years ago, just from what we expected this time a year ago. So you've got earnings at all-time highs. You've got an employment backdrop that is aging, but as we saw the recent job data, it's not just falling off a cliff. Yes, people, it's a little hard. It's actually a lot harder to get a new job right now. People are staying where they are, but people are not getting laid off. So when you see the aging labor force, but it's still a healthy labor force, with the dovish Fed, with the consumer that continues to surprise the upside, with services that continue to be strong. Yes, I think we just saw some manufacturing data again this morning, a little weak, not perfect, but the services part of our economy is much larger. And then the cherry on top, in our opinion, Kristen, is productivity. We haven't seen strong productivity in our country since like the mid-90s for an extended period of time. We are seeing finally stronger productivity. That to us, we've been saying for almost 2 years now, we expected to see stronger productivity, and that could be this magic elixir to keep this economy and bull market going. And fortunately, it's all happening.
Certainly, it does seem to be a lot of tailwinds playing a factor here, Ryan. Certain sectors that you anticipate that could outperform based on what we see shaping up this earnings season.
Sure. I mean, the two that we've talked about all year are financials and industrials, and I know they've been on fire lately, which I'm not complaining about. I mean, look, I can't give individual recommendations, but a stock like GE, okay, it is like the highest it's traded in over 20 years. That's obviously a big industrial name. Then you look at financials, like there's the big 6 financial names since Friday morning when financial earnings started, up like 7% on average. So again, it's early in earnings season. Let's be very clear. But again, we think the economy is on stronger footing than people give it credit. You've got record highs in the financials, industrials, but also relative strength versus the S&P 500, hitting 52-week highs or all-time highs. Those are tailwinds, again, that we think are really positive. The other group, I know sometimes it's a dirty word. We've had a slight overweight to small caps all year. Yes, they've been frustrating, no question about it, but they are historically cheap relative to large caps, and also small caps do a lot better once the Fed actually starts cutting. So again, we saw Friday, right? Almost 90% of the Russell 2 was higher on Friday. That might be kicking off again another period of outperformance from small caps. Honestly, mid caps also have probably been our largest overweight. So those are some areas we like here, Kristen.
Any seasonal trends, Ryan, that you're watching that could fuel markets, of course, in these next few weeks? Yes, amid earnings, but also approaching the election.
Well, we are approaching, yes, the election. Oh boy, here it comes. Yeah, today's Tuesday, right? So just a few weeks from today. But you think about it. Here's what we know. October is the most volatile month in an election year. It's actually the worst month on average. Now that's skewed because of 2008 and some other big drops. At the same time, we're still thinking it's possible after the S&P's up 5 months in a row. After the S&P's up 10 of 11 months. As we get closer to the election, we could have some skittishness. And I know this morning, crude oil's down 5% on some optimism about the Middle East, where they're going to attack, where they're not going to attack. The reality is, again, the economy's strong. Yes, we're probably going to get some pre-election jitters. One final number here: when you're up 20% for the year on the S&P going into October, the month of October has only been higher 2 out of 9 times, down like 3% on average. So believe me, we've been bullish. We're still overweight equities. We're just saying let's be open to the idea of one of those quick 4 to 6% potential, kind of hiccups, if you will, sometime before this election.
So GDP growth up 3%, of course, in the third quarter. We expect a decent earnings season. It seems like there really aren't any signs, Ryan, of a recession out there, that the so-called soft landing has officially happened. What do you think?
Well, we do. I mean, listen, we've been on record, soft landing, hard landing. We've been saying for a year and a half, the plane had plenty of fuel. There's no landing needed. That's kind of the lingo we've used, and we're still there. Now, listen, let's talk about maybe some worries, because there are a lot of positives out there. A lot of people are turning bullish all of a sudden. Just this morning, that Bank of America Global Fund Manager survey, I didn't get total time to dive into it, but take a wild guess. People are optimistic. Now the economy's good. Everyone's realizing that things aren't that bad. The Atlanta Fed GDP now says we might have 3%, more than 3% GDP growth this quarter. So that'd be back-to-back 3%. I mean, there's a lot of positives. Maybe from that contrarian point of view, we need to kind of upset the apple cart a little bit after up 10 of 11 months. That's perfectly normal. But again, the bottom line, the consumer's still healthy, right? Initial claims spiked last week, but then you kind of look where it was in our country. Obviously, so many people impacted by the hurricane. That's why that happened. So still, we're still optimistic, but maybe my biggest worry is everybody's realizing things aren't that bad. And now Mr. Market might surprise a lot of people here.
Ryan Detrick, thank you so much for joining. We're going to check in with Ryan after the market opens. Ryan, of course, from the advisory firm Carson Group. Welcome back to NYSE TV Live, everyone. I'm Kristen Scholler, down here on the floor of the stock exchange, and rejoining me now is my markets guest from earlier, Ryan Detrick, of course, of Carson Group. Ryan, we see the stock market opening a bit mixed, but still some strength out there, of course, on the back of these bank earnings, those big money center banks rising at the open. What could we expect would be in store for today's session?
Yeah, I think, we've got a little hangover from the holiday yesterday. Yesterday was really light volume. Yes, we hit all-time highs. By the way, it looks like a fun party on the floor right there this morning. So that's pretty lively. You can tell it's a bull market. But again, this today, I think the story, I kind of talked about a little bit ago, crude oil. I mean, crude oil is down big time. Like, it was down 5% a little bit ago. That's kind of caught, obviously, the attention with the Middle East tensions. Maybe we're not going to attack some of those facilities we thought that Israel's going to attack. So that's potentially a positive on that front. But again, this week, I hate to say today is kind of boring. To be honest, it is. It's later in the week. Got more big earnings come up, and then Thursday, you got retail sales, industrial production, initial claims. So we're kind of looking forward. And again, just kind of, getting a lot of people getting back to work. Obviously, bonds were closed yesterday, so light volume day. So overall, though, with the election 3 weeks away, that's another big bullseye we're going to be talking a lot about as we get closer.
It's interesting, Ryan. I know you follow the chart patterns and obviously the data, the historical data and trends very closely, but historically over time, we have seen October be a more volatile month. And despite what we saw, of course, at the beginning of the month with tensions rising in the Middle East, we've seen relative calm, what appears to be relative calm these past few days. Is that surprising to you, considering what we've seen happen in October over time?
I'm going to blame you if you just jinxed it, Kristen, by the way. But no. Yes, I mean, it is pretty rare. I mean, October is the most volatile month. You tend to have more VIX spikes in October than any other month. You get more 1% up and down moves in October more than any month. Now, this month, obviously 2 weeks in, give or take, we've bucked that trend. It is interesting, though, like to start the month of October had a little bit of a dip. Obviously, to start the month of September, had a little bit of a dip. We had that 8% violent pullback to start the month of August. So for whatever reason, the beginning of months have been rough, but then we kind of fight and claw and scratch our way back. Historically, getting real into history here, it's kind of the latter half of October that does a little bit better. It is the first 3 weeks or so that's worse. Of course, October 19th, 1987's in there. Yeah, that skews things a little bit because that was a stock market crash in 87. But the reality, again, is October, I would be pretty surprised if we didn't have more volatility before this election in 3 weeks. And by more volatility, I'm talking maybe a little bit of downside and a little bit of risk, taking off risk again ahead of the big event in 3 weeks.
Ryan, we see the S&P 500 up more than 60% from that bear market low in October of 2022. As our investors and our viewers look at where we are in the economic cycle, what would you tell them in terms of what kind of churn we might be seeing from here?
Well, first off, I talked a little bit ago about the bull market. The third year of the bull market historically is kind of choppy, not all that great, because usually your first 2 years are really good. Like you said, we're up over 60%. Your average first 2 years of a bull market is like 58%. So we're right there. But again, I mean, listen, Mark, when do things really usually peak? It's when there's a lot of optimism out there, when people are really excited. I know I get to work with financial advisors every day, talk to their clients. We're simply not seeing that. Just look at consumer confidence, okay? Any of the different consumer confidence that are out there. Not saying we couldn't peak tomorrow. We don't expect that to be the case. So you're going to need to see more confidence coming in, Kristen, before you get to that ultimate peak. I think that's just kind of how we see it. And one other thing, once a bull market actually gets to 2 years old, like this one has, you know what? They usually keep going. We've had some shorter ones, yes, but once you get to that second year, like we have, that momentum can continue. Doesn't mean your third year is going to be just rip roaring, but bigger picture, again, with this economic cycle of growth, with the Fed cutting, with really no major signs of a monster under the bed, we think that it's like a cruise ship, right? Once it gets moving, it can keep moving. There's still a good deal, likely a good deal left to this economic cycle of growth. Now, the Fed's cutting, two things here real quickly. Housing's been an issue, no question. Fed cutting. We haven't really seen mortgage applications start to spike yet, but with a few more cuts, we think that's the case. And what drives businesses? It's small businesses. What drives the economy? Small businesses. More people work for small businesses in the United States than anything else. So small businesses are kind of, with higher rates, it's harder on them, right? It's harder to get those loans. It's harder to pay employees as much as you want when rates are higher. But with lower rates, that could be a tailwind for small businesses and for housing, two parts of our economy, Kristen, that honestly have not held up all that well the last couple of years. We're optimistic it'll do a lot better next year.
Ryan Detrick, so appreciate you joining us, of course, a market strategist with the advisory firm Carson Group. Ryan, thank you again.
Thank you.